This is Michael Kolb, CFP from Evergreen Well Solutions here with your October monthly market update. Unfortunately, October was not a great month for market, with all three major U.S. stock markets down for the month. The broad-based S&P 500 was down over 2%, and the tech-heavy NASDAQ was down over 2.75%. Despite these losses, fundamentals were actually pretty good, with about 58% of the companies reporting so far. Earnings were actually up 2.8% for the quarter so far, which is a lot better than the decline of 1.2% that we actually expected for the quarter. So great fundamentals, and this can actually represent really good signs for companies going forward. However, on the other hand, we had really bad technicals for the month. Both the Dow Jones and the S&P 500 both ended below their 200-day moving averages. This is not good and can signal a downward trend. The NASDAQ actually did go above its 200-day moving average at the end of the month, but it's something that we're going to want to make sure we monitor for short-term trends. Very similar story internationally. The international MSCI EFA index was down over 4%, and the emerging markets index was down about 3.87%. Why did this all happen? Well, it was all interest rate driven. And interest rates rose substantially throughout the month, from 4.59% up to 4.88% on the 10-year Treasury. That's quite the substantial rise. And this hurt not only bond prices, but it also affected the equity markets. So the bond market dropped about 1.58%, and the high yield index dropped about 1.16% as well. So is this a positive? Is this negative? What does this mean for the economy? Well, the economy is still growing. It's slowing a lot in terms of its growth, but it's actually still growing. Surprisingly, third quarter GDP, or the amount that our country's actual overall output increased for the quarter, was up 4.9%. That's way above the 2.1% that we had in second quarter of this year. It's a really strong growth rate. And that's actually on a rising personal consumption throughout the quarter and a really, really positive labor market. September's employment report actually showed a surge in hiring of 336,000 jobs. That's way over the 170,000 that we expected. So a lot of great updates recently on the overall economic outlook. However, consumer sentiment has shifted the opposite way. The following markets throughout September and October, along with the rising interest rates, things like high fuel prices and the slowing housing sector, all these things have really weighed on sentiment. And this can actually, this has brought it down to a 5-month low. And this can be a real headwind for consumer spending, which is a massive part of the US economy. So given that importance of that spending, and something we really want to watch is that consumer sentiment to make sure that it's not something that continues to climb even further. One area in particular that I mentioned that was affected by these rising interest rates was housing. This has slowed a lot. The combination of high prices, rising mortgage rates, limited supplies, these have all combined to really decrease sales down to less than 4 million from its peak of over 6.5 million back in January of 2021. So something that really filters out to the rest of the economy. It changes sentiment perspectives. It actually goes across the board into other sectors. So something we're wanting to make sure we monitor as interest rates went from 3% to about 6.5% at the beginning of the year and over 8% at one point in time last month as well. So there's other risks too. We need to make sure that we're monitoring inflation. If inflation were to pick back up again, that means rising interest rates, which therefore again has a additional effect on all of these areas that struggled last month. So it's something we want to keep an eye on. Inflation increased a little bit, but things like fuel prices came down. There's some sticky factors that we're watching, but in the long term, interest rates are slowly coming down, but we really want to continue to see that movement. And that's something we haven't seen throughout the month of October. We also now have an additional international war with Israel and Hamas to go with the Russia-Ukraine conflict, and China is still concerning. There are a fair amount of widespread defaults across the property development sector, and this has been limited in scale and scope so far, but it's something to pay attention to. So despite all of this, the outlook is still rather positive. Earnings are great, which is a huge indicator of future success. And it's also really important to remember that slow growth is still growth. So while it was really volatile in September and October for investors, this is often the case. Often September, October are down, and then November and December are up. In fact, November and December are usually two of the best months of the year. So Given these improving fundamentals and the economic backdrop, we think that there's a really good intermediate to long-term outlook, but there probably is some turbulence still in the short term. So remember your diversification, remember your goals, and if you have any questions, contact your Evergreen Well Solutions advisor. Thank you and have a great day.